You don't have to be brilliant, only a little bit wiser than the other guys, on average, for a long time. Have you ever wondered what sets successful investors apart from those who face financial struggles? In today's video, we're going to reveal the strategies of Charlie Munger and Warren Buffett, two of the greatest investors of all time. Get ready to discover how their approaches can transform your financial life. What secrets do they hide behind their investment decisions? And how can you apply those secrets to achieve your own financial goals? Keep watching to find answers that could change your perspective on money. Charlie Munger and Warren Buffett are synonymous with success in the investment world, but what really makes them so effective? The combination of wisdom, discipline, and a pragmatic approach to investing is what separates these two giants from most investors. Let's unravel their philosophies and strategies. Munger says, "The big secret to success is avoiding stupidity." This advice, though simple, carries deep wisdom. Avoiding obvious mistakes is an efficient way to minimize losses. A remarkable example of how they apply this philosophy is Buffett's investment in Coca-Cola in 1988, a widely known move. Buffett didn't just invest because Coca-Cola was a popular brand. He dug deep into the company. He saw that Coca-Cola had a resilient business model and a strong global brand, giving it a sustainable competitive advantage. In 2023, Berkshire Hathaway still held around 400 million shares of Coca-Cola, showing how long-term investment based on solid fundamentals can generate incredibly profitable results. The current value of that investment exceeds $24 billion, a huge return from the initial $1.3 billion investment. How many times have you invested without a clear understanding of the company's real value? Have you followed the crowd or made choices grounded in deep analysis and knowledge? Thinking like Buffett and Munger means moving away from fads and seeking companies you truly understand, focusing on their capacity for long-term growth and resilience. This grounded approach could be the turning point in your financial success. Investing with emotion can be one of the biggest obstacles to achieving financial success. Many investors act impulsively, driven by panic or euphoria, which can devastate their portfolios. Munger and Buffett, on the other hand, have an extremely rational approach. They know that emotions can cloud judgment, so they make a conscious effort to avoid them. Munger states, "The ability to stay calm and not react emotionally is a tremendous advantage." A perfect example of this ability was during the 2008 financial crisis. While many investors sold their stocks in desperation to avoid further losses, Buffett saw an opportunity. He invested billions in companies like Goldman Sachs and General Electric. The logic was simple. These companies were temporarily in crisis due to the overall economic situation, but their foundations were strong and recovery was inevitable. Buffett's bet earned Berkshire Hathaway billions. The lesson here is clear. Staying calm during turbulent times can open doors to valuable opportunities that others are ignoring due to panic. How do you react when the market fluctuates? Are your investments driven by fear of loss or the opportunity to gain? Learning to stay calm, like Munger and Buffett, is one of the most powerful lessons for the modern investor. They understand that to succeed, you need patience and trust in the process, resisting the urge to act impulsively. There is no substitute for knowledge in the world of investing. For Munger and Buffett, investing in financial education is the first step to making smart, well-informed decisions. A deep understanding of companies, sectors, and economic trends is what differentiates great investors from amateurs. Munger says, "Investing in knowledge is the best investment you can make." Buffett is a great example of this. For years, he resisted the idea of investing in Amazon, but after extensively studying the company, its business model, and Jeff Bezos' vision, he realized he was facing a rare opportunity. In 2019, Berkshire Hathaway finally bought shares of Amazon. Buffett, who had always been cautious with tech companies, didn't make this decision lightly. His in-depth research and understanding of Amazon's long-term potential resulted in a highly profitable investment. With the stock's appreciation, Berkshire Hathaway saw its investment in Amazon grow rapidly, showcasing the power of knowledge. Are you dedicating enough time to understand the market and the companies you invest in? Or are you just following third-party tips without doing your own research? The lesson here is that research is not just a preliminary step but a continuous practice. The more you know, the better your ability to make solid choices that stand the test of time. Diversification is often seen as a way to protect your portfolio, but Munger and Buffett have a slightly different approach. For them, over-diversification can be a sign of a lack of deep knowledge about the companies you invest in. Focusing on a few assets, as long as they are well understood, can yield more. Munger states, diversification is protection against ignorance. Buffett, on the other hand, has always preferred to concentrate his investments in companies he deeply understands. An example of this is Berkshire Hathaway's investment in Apple. Buffett invested heavily in Apple, even when many still saw the company only as an electronics manufacturer. He understood that Apple was transforming into a tech giant with an ecosystem of products and services that generated exceptional consumer loyalty. In 2023, Berkshire Hathaway held more than $150 billion in Apple stock, representing nearly 50% of its total stock portfolio. This focus allowed Berkshire to reap the rewards of Apple's explosive growth. How do you balance diversification and focus in your portfolio? Are you diversifying because you truly understand all your investment choices, or are you protecting yourself from ignorance? The key is finding a balance, investing in companies you know deeply and have confidence in for the long term. In the investment world, patience is not just a virtue, it's a necessity. Munger and Buffett are masters at the art of waiting for the right moment and holding their positions for long periods. Regardless of market fluctuations, Buffett says, time is the friend of wonderful businesses and the enemy of mediocre ones. An example of this is Buffett's investment in Apple, which he held for years despite stock price drops over time. Instead of panicking and selling, he trusted his initial analysis that Apple had a robust business model and a unique ability to innovate. His patience was rewarded as Apple's stock value soared, making the investment one of the most lucrative of his career. Are you seeking quick returns, or are you prepared to hold your investments long-term, regardless of short-term fluctuations? Learning to cultivate patience and persistence could be the key to ensuring sustainable financial success. Mistakes are inevitable, but learning to avoid them is crucial to preserving and growing your wealth. Let's identify the most common mistakes and how to avoid them based on lessons from Munger and Buffett. Munger warns, if you're doing something because everyone else is doing it, you're on the wrong path. During the dot-com bubble, many investors bought tech stocks without understanding their real value, just following the market trend. When the bubble burst, those investors suffered massive losses. Munger and Buffett, however, avoided this sector until they had a clearer understanding of how it worked, saving them from major losses. Are you following the crowd or carefully evaluating your investment options? It's essential that you make choices based on data and not fleeting trends. The art of reevaluating and adjusting strategies. Introduction. Reevaluating your strategies is a constant practice among great investors. Munger and Buffett regularly review their approaches to adapt to new market conditions. Munger suggests, change when circumstances change. When the 2020 oil crisis shook the energy market, many investors clung to their traditional energy stocks despite the global shift towards renewable sources. Munger and Buffett, however, began reviewing their portfolio, recognizing that the future of energy was in cleaner technologies. This strategic adjustment ensured they weren't caught off guard by significant changes in the sector. When was the last time you reviewed your investment strategies? Are you keeping up with market changes to ensure your portfolio remains relevant? Life philosophy has a direct impact on financial success. Both Munger and Buffett live according to simple principles such as frugality, patience, and continuous learning. Buffett believes that the best investment you can make is in yourself. This principle applies not only to financial investments but also to personal development. Buffett invested time and resources in his own education and skill building over the years. He learned about communication, leadership, and decision-making, and these skills were crucial to his journey toward financial success. How do your philosophies and life habits influence your finances? What can you do to improve and achieve your financial goals? Today, we explored how focus, patience, research, and reevaluation are essential for financial success. The lessons from Munger and Buffett show that an informed and strategic approach is key to thriving. Did you enjoy the video? Give it a thumbs up and subscribe for more tips on finance and investments. Share this video with your friends so they can also learn from these valuable lessons. Remember, financial success doesn't happen overnight. It requires continuous learning and careful decision-making. See you next time.